Hello everyone and welcome to lesson 2 of this training. We'll be talking about forms of trading now. We're talking about forms of trading. In Forex markets, two things are involved. It is either you buy or you sell. It is either you buy a market or you sell a market. Now, you can't just decide to buy or sell the market. Something would warrant you to buy or sell. Something you would have confirmed from something before you decide to buy or sell, because you don't just want to enter the market like a novice. You want to trade like a professional. So it is either you analyze the market fundamentally or technically. So that is the basic forms of trading we have. We have the fundamental analysis and the technical analysis. Now, fundamental analysis is a form of analysis in which you watch or read the news and you trade based on the results you get from the news, based on the interpretation you give the news. Now, if the news is positive, definitely it is a good news for the economy and it is going to affect the economy in a positive way. Then if the economy is affected in a positive way, the currency of that economy is going to add value. But if the news is negative, it's going to affect the economy negatively. And the currency of that economy is going to do what? It's going to lose value. It's as simple as that. So that is what fundamental analysis is all about. And for you to know that the economy of a country is going to gain value, let's say the US economy, for example, if you know from news that the US economy is going to, is going to be better, then it is a good news because the currency of the US economy, which is the US dollar, is going to increase in value. So that is the perfect time for you to buy the currency pair. That would be the perfect time for you to buy the currency pair because you know that the value of the currency pair is going to increase and you will make money. But if you read the news and you see that the news is a bad news, then it's going to affect the economy of that country. And definitely it's going to affect the currency pair of the country. So definitely the value of the currency, let's take for example US dollar, the value of US dollar would depreciate in that instance. So are you going to hold on to a currency pair that the value would depreciate? No, that would be the perfect time for you to do what? For you to sell. So that is just what fundamental analysis is all about. Now, various things are being released every day, and it is either they affect the market positively or negatively. Now, you can watch all these news on CNN, CNBC, Bloomberg. You can also, if you don't have access to cable at all time, you can check websites like forexfactory.com, Daily FX, and so on. There are so many news websites like that that gives you news updates so that you can trade based on the interpretation you give the news. Now, as forex trader, you make money both ways. If the news is good or the news is bad, you make money both ways. So let's move on. An important news that is being released is the NFP. A very important news, which is the NFP, the non-farm payroll, and it is released by the United States of America. It is the king of all news because it causes most volatility in the market. Anytime this particular news is being released, the volatility in the market is always massive. So everybody around the world wants to trade in that kind of markets because remember I told you in lesson 1 that volatility is what we eat as forex traders. We want to see markets volatile. That is why we come around and trade when 2 or 3 markets are open at the same time, because we know that the volatility will be better at that moment. But anytime NFP is being released, the volatility is massive, more massive than even when 3 trading sessions are open, because people all around the world are waiting this news and they want to trade based on the results they get from this news. Now, it contains data and statistics released by the US Bureau of Labor and Statistics. It is a very influential indicator of the economy because the US Federal Reserve make monetary policy decisions based on this news. If the news comes out and okay, based on the result they get from the news, they make their monetary policy decisions. Then take a look at this. Investors, financial analysts, forex traders like you and I, stock traders, we make trading decisions based on the release of this news. We make trading decisions based on this news. That is to show you how important NFP, which is a non-farm payroll, is. Let's move on. So this news is released every first Friday of every month by 12:30 GMT. So if you are anywhere around the world and you know that it is 12:15, let's say you are traveling and you know that you want to trade NFP, just park maybe 15 minutes to NFP and bring out your laptop as far as you have internet connection and trade NFP. You won't even believe some traders, they trade just once in a month. They just come, they load their trading account, they trade NFP, they make profits, good profits, and they close their account for the month and come back the next month to trade another NFP. That is to show you how massive NFP is. So this data, the data that is being released in NFP includes the non-farm payroll increase. This is the total number of employment that has been added to the US economy, excluding the farm, the agricultural industry. It is also, they also release the unemployment rate. That means the total unemployment rate of the US economy. Now take a look at this too. If there is more employment in the economy, it's good, right? So it's good for the currency pair. If there is less employment in the economy, it's bad. That means it's bad for the currency pair, it's bad for the US dollar. So that is how powerful this news is. And this news also tells us the sector the jobs were added to. It tells us the average hourly earning of US workers. And it also gives us a revision of the former one. If you don't know the former employment rate, how are you going to know if the economy is moving forward or not? It is when you know the former, the past results, you then compare the new, the present result, and you can now ascertain that, oh, the US economy has either increased, has either like the US economy is better or it is worse based on the revision of the past non-farm payroll and also the release of the present non-farm payroll. So that is just to show you how powerful this news release is, and traders all around the world, they look forward to trading the NFP. You know, you are as from now on, you don't want to miss NFP. Trust me, you don't want to miss NFP. The volatility is always massive. The volatility is always massive. And you know, along this course, in some way, along this, like, okay, sorry, I'm trying to target a trade and I don't want to miss it. Okay, so before the end of this course, I'm still going to teach you some specific strategies of trading the NFP. I'm going to show you how you can easily trade NFP and make good profit for yourself every month. So the next form of trading is the technical analysis, and is the most popular form of trading because you don't get to see news released every day. High volatility news are not being released every day. Like take for example, NFP is just released once in a month, and if you are the type that you don't want to be waiting once a month to trade, then that is where technical analysis comes in. So it's a form of trading in which you use so many things to decide if you want to buy a currency pair or sell. So you use indicators, chart patterns, candlestick, Fibonacci, support and resistance, pivot points, Elliott wave, and so on. And so on. There are so many forms of technical analysis. Now, as a Forex trader, you need to learn how to maximize markets using both fundamental and technical analysis. You don't just want to know one and leave the other one aside. You need to learn how to balance these two so that you can come up with good trade setup and you can be profitable in this business. So that is all about the form of trading. So we are going to move to lesson 3, currency pair. Let's talk about currency pair. Forex simply means foreign exchange. Forex simply means what? Foreign exchange. So an exchange cannot happen. Let me write it down. Foreign exchange. And trust me, an exchange cannot happen if we don't have two things involved. An exchange cannot happen if you have just one thing. So before an exchange can happen, you have to bring two things together. So that is why Forex does not just come like a single that you want to buy US dollar, you want to sell euros. If you want to buy US dollars, what are you going to buy it? What are you going to buy it with? So in Forex, Forex is quoted in what? In currency pair. It's quoted in currency pair. That means two currencies together, two currencies in exchange, like one currency in exchange for the other. So each currency is given a three-letter code. We all know about all these common currency pair. We know about euros. We've heard of euros, US dollar, Great Britain pounds, signified by GBP. Japanese yen, anytime you see Japanese JPY, you know you are referring to Japanese yen. CHF means Swiss franc. AUD means Australian dollar. CAD means Canadian dollar. NZD means New Zealand dollar. So these are the most common currency pairs. These are the most common currency pairs. And I'm very sure it's something we would have, come across before. So now there are some currency pairs that are more liquid in the sense that a lot of people are always actively trading in these currency pairs every day. So the currency pairs include the EUROS USD, GBP USD, USD JPY, USD CHF, AUD USD, NZD USD, USD CAD. They are the most common and liquid pairs. Now we have other pairs. We have the Swedish krona, Danish krone, Norwegian krone, Singapore dollar, South African rand, Nigerian naira, Chinese yuan, and so on. We have so many, a lot of currency pair. By the time we install a trading app, you get to see and understand how all these things work. So this is how they appear if you are using an Android phone, if you are using your phone to trade on your trading app. This is how it appears. You can see what we just talked about: EUR USD, USD JPY, GBP USD, USD CHF, and the values are written in front. We'll still talk about that when we move to the metaphor interface. So now, among these pairs, we are still on currency pair. Among these pairs, the first currency pair is called the base currency, while the second currency is called the quote currency. What I mean is that, let's take for example, we have a currency pair, EUR USD. In this particular currency pair, the first currency pair that is being listed, the first currency pair here is EUR, is the base pair, is the base currency. While the second one is the quote currency. The first one is the base currency, while the second one is the quote currency. And the base currency is always stronger than the quote currency. Anytime you see a currency pair appear first before the other, that means most times, that means it is stronger than the other one. So the base currency most time is always stronger than the quote currency. Let's take for example, let's see an example here. Take a look at EUR USD here. The value for EUR USD. The value for EUR USD at this point is, this is euros to US dollars, right? And euros is appearing first. USD is coming second, which makes euros in this kind of situation the base currency and US dollars the quote currency. So this is the value. I'm still going to explain what the second value stands for. This is the value 1.1257. 1.1257. Let me write it out. Euros USD 1.1257. What this simply means is that for you to get 1 euro, you need 1.1257 US dollar. Let me write it out here again. 1 euro equals 1.1257 USD. So I'll take it again. For you to get 1 euro, that means you need 1.1257 US dollar. This shows that the value of euros is bigger than the value of US dollars because you need 1.1257 to get just 1 euro. That is why euros is appearing as the base currency and USD as the quote currency. Let's move on. So this is how most currency pairs appear. The base currency is always the first one, while the second one is the quote currency. But there are exemptions. There are some exempted pairs like AUD USD, NZD USD, EUR JPY, AUD USD, NZD USD, EUR JPY. These are some of the exemptions we have. Reason being that in this exemption, the quote currency is bigger than the base currency. The quote currency in this situation is bigger than the quote currency in this situation is bigger than the base currency. Let me show you an example. This is an example, USD CHF. USD CHF. USD CHF, the value is 0.9943. The value in this place, at the time I took the screenshot, was 0.9943. This simply means, let me spell it out. This simply means for you to get $1, you need 0.9943 Swiss franc CHF. So that means for you to get just one single dollar, you need less than one to get less than one of CHF to get $1. This shows that CHF in this particular situation, which shows that Swiss franc in this situation is bigger and has more value than what? Than the US dollar. But US dollar is written as the base pair and CHF as the quote pair because this is an exemption. We also have other exemptions. Take a look at these two. EUR JPY is also an exemption. AUD USD is also an exemption here. So that is that about the base and quote currency. You would notice that the exempted pair always starts with 0 point something. The exempted pair always starts with 0 point something. Like the exemption, part of the exemption is USD CHF. You can see that it started with 0 point something. EUR GBP started with 0 point something. AUD USD started with what? 0 point something. So the exempted pair always starts with 0 point. It always starts with what? With 0 point. Let's move on. Let's talk about the last thing for this lesson. When do you buy and when do you sell? Now, a lot of people get this confused every time. And that is why it is good for you to, to select, to get yourself a proper mentor that is going to, mentor you in this business. A lot of people think when market is going up, I need to buy. When market is coming down, I need to sell. It is a totally wrong idea. It is a totally wrong idea. Let me give you an instance. Let's say you are buying. Let's say you want to buy a market. Okay, let me put it like this. Let me break it down. Let's say this is a market. A market is going up. A market is going up. And as a novice, you now look at this market. Oh, this market is going up, it's going up, it's going up. I need to do what? I need to buy. You now buy. Do you realize that you are buying at a high price? You are buying at a very high price, and it is bad because for you to buy at a high price, how much now do you want to sell? Now, the best thing, now compare it with someone that bought around this price. Someone that bought around this price when price was still low. Someone now bought from this price, and you are now buying from when price has already moved. you see that the profit margin this person would make would be larger than what this person would make in this trade. Because it is even dangerous for you, because what if you buy at this point and market now start selling at the point? Are you getting me? So you don't buy when price is going up. Reverse is the case. Reverse is the case. Let's say market is coming down. You now decide to do what? Sell. You are selling at the wrong time because you should have sold here so that you can make better profit. So this now brings me back to my point. You buy when you know that the market would go up, and you sell when you know that the market would go down. Can you see that the wood is in capital letter and in bold format? You buy when you know that market would go. That means market has not even moved. That means market has not even gone up. Let's say market is still here, but you've done your analysis, your fundamental and technical analysis, and you know that in the nearest future, market is going to do what? Market is going to buy. You know that market is going to buy in the nearest future. So what are you going to do? You are going to do what? Buy. So by the time you are buying at a better price. You are buying at a low price. You are buying at a very low price. And if market now moves in your direction, then you'll be in massive profits. Imagine you buying at this price and now selling A. You are buying at a low price and you are selling when price is already high. That means you'll be in massive profits. Now you also sell when you know that market would go down. That means market, let's say market or see some, let's say market you the other time you bought, right? And you did another analysis and you know that market has already, bought. And you did another analysis and you notice that market would soon start selling. You know that market would go down. So what are you going to do? You are going to sell. You are going to sell at high price. So eventually when market now changes direction and now starts moving down, you'll be what? You'll be in massive profit. I hope you understand this analogy. If you don't understand, you can easily still, send me an email. I will reply and, ask your questions. Or you can send a message to the WhatsApp line I'm going to drop at the end of the course. So again, let me do a recap. You buy when you know that market would go up. That means market has not gone up. And you sell when you know that market would go down. Markets would go down. Now, this was what happened to a lot of people that bought Bitcoin around 2017, when Bitcoin price, rose up to 17,000, 19,000 something. They decide to do what? They decide to, market is going up, market is going up. They start rushing market, let's buy. They are buying at the wrong price because price has already moved, price has already bought. And that was when they were buying. That was why, a lot of them recorded a lot of losses. By the time market now dropped, market now started selling. So this knowledge is just for you to, expand and, understand the basic in this business. And in any business you even do, let's say you are selling a clothes, you are selling clothes. Let's say you are into fashion business, and then you want to purchase a particular product. Let's say you saw some, let's say you saw some good selections of clothes, and you know that how much you want to sell it. Let's say you saw those goods around $100, and your customer already know that you always sell your clothes at $50. Are you going to buy in that kind of situation? No, because if you are buying at $100 and selling at $50, you'll be in loss. But probably you now wait for the price to go down. Let's say the price now goes down to $25 from the $100, it goes back to $25. Then you know that, okay, that time is the perfect time to buy, so that you can sell at high price of $50. So it is simply the laws of demand and supply, and that is how this forex market works. So I hope you understand all what I've said so far. If you understand, just like I said, you can easily send me mail and I'm going to reply you. So Thank you all for today. Join me in the next lesson. Bye.